second quarter of 2023 was a more mixed one for financial markets globally, following the positive first quarter. In Q2, tech assets did particularly well, driven by enthusiasm for the AI theme. Volatility in markets subsided through the quarter after concerns around US banks were allayed by central bank intervention. The successful resolution of the US debt ceiling also served to ease market concerns. Global bonds lost ground as inflation remained sticky, forcing central banks to keep lifting interest rates. In South Africa, the story so far for 2023 remains the same, and that really is all about load shedding, unfortunately. The US Federal Reserve raised interest rates further in May. This took borrowing costs back to levels last seen in 2007 before the global financial crisis. Higher rates do appear to be succeeding in their aim to cool high inflation, which did allow the Fed to pause their rate hiking cycle in June. We do, however, expect one more rate hike to come in the third quarter as the final one of this cycle. In general, recession fears continued to recede through the second quarter of the year, with increasing talk of a so-called soft landing. The short-term data certainly suggests that central banks might manage to cool inflation to the target of around about 2% without causing a recession or a material increase in unemployment. We're not so sure, and really this is a fascinating debate where both sides of the argument make a degree of sense. Historical precedent is on the side of a US recession within the next year, as there's no meaningful history of a major central bank-induced inflation slowdown without a subsequent recession. A variety of the leading indicators also continue to point towards a recession, and we remind viewers that it does take time for the impacts of rate hikes to play through to the broader economy. The signal from global bond markets is clearly pointing towards an economic slowdown in developed markets in the latter part of 2023 or maybe early 2024. By contrast, equity markets are generally taking a more optimistic stance. Here, the argument for avoiding a recession focuses on the fact that recent inflation was driven by the COVID shock to both demand and supply, so history might be a less meaningful guide. Long-term inflation expectations do remain quite well anchored in developed markets, and the labor markets in those countries are generally more flexible than they were historically, with lower union membership. So these factors serve to reduce inflation stickiness. Overall, our base case scenario at Sanlam Private Wealth remains for a mild recession, which we now expect to arrive early in 2024. Either way, as always, our focus is on constructing portfolios for clients that are robust to a variety of different outcomes. In terms of asset class performance, equities did best, with the MSCI World and S&P 500 indices rising 6.8% and 8.7% respectively over the quarter. The Euro stocks in Europe fared similarly, up around 4% in dollar terms. The MSCI Emerging Markets Index lagged global averages and returned only 1% in the second quarter. From a style perspective, growth stocks definitely performed best, delivering more than 10% in the second quarter to be up over 27% in the first half of the year. Global equity markets remained very narrow through the quarter and through the half, with most of the S&P 500's returns so far in 2023 driven by only 7 stocks. Meanwhile, persistent core inflation and a tight labor market across the developed world resulted in interest rate expectations being revised higher during the quarter. As a result, bonds underperformed, with the Bloomberg Global Bond Index falling by 1.5%. In China, the reopening of that economy does appear to have lost some momentum, leading to calls for fresh government stimulus. The MSCI China Index declined by 9.7% in US dollars during the quarter, materially underperforming both global equities and their EM peers. Commodity prices traded lower in Q2, with weakness basically across the board. Brent crude oil fell by 6%, despite OPEC announcing certain production cuts, while copper and gold were down about 9% and 2.5% respectively. When looking at South Africa, the rand certainly had a wild ride, fluctuating between 17 Rand 80 to the dollar at the start of the quarter, peaking at around 19 Rand 80 to the dollar and ending at around 18.80. Thankfully, it has strengthened subsequent to the end of the second quarter. Our local equity market lagged its emerging market peers, down about 5% for the quarter in US dollar terms. The numbers do look a bit better when expressed in rands, with the Aussie in South Africa up around 1% in our local currency. Within our market, financials performed best, while resources lagged, pretty much in line with lower global commodity prices. Our local bond market lost 1.5% through the quarter, while cash delivered you about 2%. The house view equity model's performance so far in 2023 is quite pleasing. We marginally beat our benchmark to deliver 5.9% for the first 6 months of the year. Over the last 12 months, this portfolio delivered 16% after fees and 17% per year after fees over the last 3 years. So far in 2023, our overweight positions in Prosus and Bidvest have delivered for us, as did our underweights to the platinum sector. Our holdings in SPAR and Sasol unfortunately acted as drags on performance. This portfolio is in the top quartile of its peer group over 1, 2, 3, 5, and 10 years. So our clients remain comfortable here. Our worldwide equity portfolio has had a bit of a tougher time of it so far in 2023, given the very narrow global market I spoke about earlier. Although this portfolio delivered a return of over 20% in rands for the 12 months to June and 11.5% for the year to date, it is behind its benchmark. While we have exposure to probable AI winners like Google and Microsoft, our philosophy does prevent us from being invested in very expensive names like Nvidia, for example, which is currently trading at more than 50 times expected earnings. If we move across to our Regulation 28 portfolios, the performance here is quite pleasing. The balanced, moderate balanced, and conservative balanced portfolios are all ahead of their benchmarks over 1, 2, 5, and 10 years after fees, and they're in the top quartile of their respective peer groups over most of those periods. These portfolios benefited from both the SA equity component as well as positive asset allocation calls. Over the quarter, in both our equity and our multi-asset portfolios, we adjusted the SA equity mix to be a bit more domestic focused. We took advantage of the negative sentiment towards South Africa through the quarter to add to local focused names like Pepkor and Absa. And equally, we took the chance to reduce our Richemont exposure and we trimmed the Anglo Gold exposure as well to lock in some strong performance. In the multi-asset portfolios, we also added South African government bonds in late May as yields spiked on negative sentiment around our economy. Overall, our positioning across our portfolios is relatively conservative, given our concerns over the impact that a material tightening in financial conditions over the last year is likely to have on future economic growth. We maintain our view from the beginning of the year that we are unlikely to see any material reduction in global interest rates in 2023. When we then look at global equities, prices are still higher than average on a forward-looking price-to-earnings multiple basis. And on top of this, we are still concerned about a seeming disconnect between consensus earnings estimates for the US market, which are slightly up so far this year, and the way that various leading economic indicators are flashing red. The VIX, which is a gauge of volatility and effectively serves as an indication of the overall market's level of fear, is now at its lowest level since before COVID came along. This does suggest to us that the US market is perhaps a little bit too complacent right now. So while the progress in AI technologies will likely increase productivity and be something of a deflationary force over the next decade, we don't expect it to be able to save the current business cycle. If we then turn our attention to South Africa, we have a materially different situation in this country. Despite the encouraging bounce from South African-focused stocks through June and subsequent to quarter end, our market is still looking quite cheap relative to both its own history and to global peers. Our market does appear to have digested the load shedding concerns, but we are a little bit worried about the progression of commodity prices and the potential impact of that on the South African government's finances in time. As we look ahead to the rest of the year, we note that while the global economy is still holding up, despite the major hikes in interest rates over the past year, We think it's premature to believe that the pain of tighter monetary policy has already been fully absorbed. We do think this is likely to remain a headwind to economic growth over the next year. Studies have shown that it generally takes 1 to 2 years for monetary policy to fully impact the real economy. Despite this, though, the global equity valuations and earnings expectations remain above trend while offering a low risk premium relative to bonds. In conclusion, we don't believe the cycle has played itself through fully yet, and we expect the investment clock to progress to a recessionary phase over the next year. In our view, the market is now less positioned for this outcome than it was at the start of the year, and hence the positioning within our client portfolios remains relatively conservative.